Hello and welcome to Rebank. I'm your host, Will Beeson. Sunny Parikh is co-founder and partner at Reflexive Capital, a fundamentals-driven investment firm focused on digital assets across two core strategies, liquid trading and venture. Sunny was previously with Point72, and his partners at Reflexive worked at Soros Fund Management, Teal Macro, and Goldman Sachs. In this conversation, Sunny and I discuss Reflexive's approach to applying ecosystem to Web3 venture, how liquid token and venture strategies are complementary, valuations in early stage Web3, investing in equity versus token businesses, and more. Thank you very much for joining us today. Please welcome Sunny Parikh. Sunny Parikh, welcome to Rebank.
Thanks, Will. I've been a long-time listener, first-time caller, so excited to be on.
It's great to connect with you. We've known each other for a number of years now, and I'm really excited to be having this conversation. Certainly followed your career trajectory over your past few roles, and am very excited about what you're doing right now at Reflexive. So to just jump straight in, it seems like the hard challenge in front of you is in such an early nascent, evolving space, trying to back concepts that are ultimately going to generate outsized returns. Talk a little bit about that.
Yeah, there's a lot to unpack there. Great question. So listen, maybe just this background. I started my career in the fintech world. I spent about 3 years at Point72 Ventures before we started Reflexive last year. And prior to that, I was at a fund called the Partnership Fund for New York City, which was a consortium of the top asset managers and financial institutions in New York. I focused on leading the effort around B2B fintech and fintech infrastructure. And so most of my life there in that world, blockchain and crypto were bad words. People didn't talk about them, or if they did, it was like there was no use case and value. And I was skeptical most of my life. And I joined Point72 to do fintech. And a few months into it, founder of the firm, Steve Cohen, got excited about blockchain and crypto use cases. And so we, as the fintech team, got tasked with the job of going down that rabbit hole. And at that point, I was still skeptical. But having spent more time as we were asked to do that, the thing that was very apparent to me was while fintech was interesting, fundamentally, blockchain's unique value proposition is it's just a better coordinator of trust and incentive alignment. And right now, if you think about all of the businesses that have been built over the past 2 decades, fundamentally, what are they? They are trust coordinators. And all the internet businesses, whether it's Facebook, Amazon, Google, Microsoft, they are coordinating trust and capturing a lot of that tax for coordinating between the brands and the end customer as intermediaries. And so what we like to think about is how can different sectors benefit from blockchain coordinating that trust, aligning incentives better, and having that transparency layer. And we can talk a little bit about how we do that, but that was the premise of the fund and what we spent time doing at Point72 as well. It can be daunting because there's so many companies and so many wild ideas. The way we get grounded and find sectors and really invest in businesses is we take a network-driven approach to investing in the space. So what that means is we spend half of our time talking to TradFi organizations, large financial institutions, asset managers, e-commerce merchants, payments organizations, people in the supply chain space, healthcare organizations, where trust coordination is hard, where incentives aren't aligned, and where we think blockchain has an opportunity to add unique value. And we talk to those people to understand what are their biggest pain points. And then we aggregate and see where the clustering of pain points are and match that with where we think blockchain technologies and crypto companies can uniquely solve those problems. And then we go and find those companies that are attacking it the right way, the founders that have that understanding of not only the pain point, the go-to-market, but are familiar with the space. That helps us get to a higher conviction level as we make investments.
You said you started Reflexive last year.
Yeah, last summer.
And if I'm not wrong, there are maybe at least two strategies. Can you talk a little bit about that and then specifically your focus?
Yeah, we have 2 distinct funds. We have 2 partners that run the liquid fund in blockchain crypto. There's tokens are liquid and trading is a unique skill set. I think a lot of trading in the blockchain crypto world is venture investors or retail. And the art of trading is a unique skill set that's been refined over a long period of time in the traditional world. And so my partners, Dave and Itai, have been macro traders working for Peter Thiel, Soros, and a few other scaled organizations over the past couple decades. And so they lead that effort. And then one of my former colleagues from Point72, Azar, and I focus on the venture effort. And so it's two distinct funds. One is trading through the cycles and capturing the upside while managing risk. And it's a very active managed strategy there. And on the venture side, it's investing through cycles and investing in long-term businesses that we think are foundational and leverage Web3. I think right now, a lot of these crypto businesses we talk about them as Web3 businesses, internet businesses, mobile businesses, cloud businesses. Decades ago, were referred to as those kind of businesses. No one now calls someone an internet business or a cloud business or a mobile business. I think you'll see that evolution as the technology becomes more and more embedded in everyday enterprise. And our goal, and we think success happens when that happens and not when you're referring to it as a Web3 business.
Totally agree with you there. How big are the funds?
We started the fund with about 70 million under management. We have a combination of family offices, some funds together that have capitalized the two funds. We also have a large university endowment that funded us a little bit on the GP side to give us operational capital over the next couple of years. So we're not letting our AUM dictate our investment style to deploy over the next couple of years.
At any given moment in the crypto industry, there's a lot going on. How has the timing of the initiation of your investment ultimately impacted where your focus is? And how do you think about the market cycle in general with respect to both the liquid token side of your firm and the venture side?
Yeah, I'll speak more to the venture side and comment a little bit on liquid side as well. On the venture side, you can't time markets. In the venture side, the approach really is understanding the problems that need to be solved and then finding companies that are solving those pain points, irrespective of market cycle. Obviously, in a bear market or tougher market conditions, capital is hard to raise. As a venture investor, regardless of market conditions, we try to stay disciplined and invest just in fundamental businesses. An example of that is we spent about 2-3 months talking to about 50 e-commerce retailers and merchants to understand what their biggest pain points were. And then I think the 3 big pain points they highlighted to us was customer acquisition, customer retention, and fraud around like returns and just broadly kind of identity fraud around payments. And we can tackle each of those. But for instance, customer acquisition in a zero interest rate environment, you had unlimited funding or almost felt like unlimited funding. And you could leverage channels like Instagram, TikTok, and others to target customers. And that felt okay. As that became more expensive, brands and retailers realized that's not sustainable. And how else can they think about acquiring new customers? And retaining customers is definitely cheaper than acquiring new customers. So then how do they continue to build relationships with that? And as we understood that and we saw a clustering of those needs, we looked to see how can blockchain, can crypto uniquely solve that problem. And I think one of the themes underlying that is just data. If brands understood who their customers were, or if you had somewhat of an open understanding of you launched a new brand for a coffee shop and who are the most avid coffee drinkers in your 20-mile radius, if you could just target them instead of using these other intermediaries that are a lot more expensive with questionable ability to see conversion, you would do that. And what we found is, as we looked at consumers, they're open to sharing their data if they're getting something in return for their value. And so there's these interesting frameworks where you can have this kind of indirect marketplace where data is captured and brands can, instead of spending $200 to target a customer, you can drop an offer to come try that product or that experience. And so one of the companies we invested in, along with Sequoia and a few other funds, is a company called Claim that does that. You get dropped an offer from a brand, connect your card, and as part of connecting your card, you share your historical transaction data through Plaid. And in return, what you get is offers continuously. It's live at Harvard and a few other college campuses, and consumers love it. The engagement we've seen through college campuses is pretty amazing. And so that's just an example of kind of a new model for if you share your data, you get something in value back, and you can cut out what the intermediaries capture, which is a huge trust tax on that consumer.
So it sounds like you, by doing the groundwork, identified an opportunity and a space that you were interested in. And then how did you ultimately source that investment?
The great thing about the crypto world is it's a pretty small world, despite all the funding that's been raised and all the founders there, it's pretty collaborative and it's pretty small. And so I think once you make it be known the areas you're spending time on, the amount of deal flow, the amount of inbounds you get, people self-select themselves into buckets. And so I think the areas what we focus on is around use cases, application layer, and solving problems leveraging blockchain. And as a result, we get to see a lot of the companies that are doing that.
What was the crypto element of that company? Claim? Is that what you said?
Yeah, exactly. It's interesting. I think the crypto and blockchain element of that is each of those offers is a tradable NFT, and they're seeing engagement around the trading aspect of it. And as you think about a world where games or other experiences open up, those offers can be moved into other form factors and other experiences. We think about it as you shouldn't have to pitch a company as a crypto company. And so we try not to think about most of the business we invest in as crypto businesses, though crypto and the aspect of crypto and blockchain is a fundamental aspect of it. And I think in the future, the other aspect there is that data. They're currently using a few data sources. In the future, we think whether it's your healthcare data, your health activity data, your transaction data, all this data has value. And so for exposing it, you can get something back in return from others that value that data or want to target you. Essentially, that's currently being intermediated by things like Google and Instagram and capturing a lot of value for doing that. How can you reallocate that value capture to the actual consumer or give the benefit to the brand directly?
I imagine when you were doing fintech investing at Point72, to oversimplify, here's a company, a structure, it's incorporated in X state, maybe Delaware. It has an equity cap table. It has a software product which has some sort of clear price tag attached to it. There's some sort of TAM or like revenue pool that you can approximate if you want to. You could probably verbalize what the revenue pool is, and then ultimately you can make some assumptions about marginality, at least at scale, and therefore probably not at the seed stage, but at some later stage you could do some math in an Excel spreadsheet and get to a sort of enterprise value or like return on invested capital. To what extent does that framework apply to the way you think about crypto investing on the venture side? And how much variation do you see in the structures and the approaches of the sorts of deals that you find interesting?
Great question. I think we spend, as I mentioned, time on the application layer, so more on use cases. And so they tend to be equity businesses in most cases, but we've definitely invested in some token businesses. So those are the two different frameworks. And then there's, I think obviously a lot of funding has gone into a lot of the layer ones and infrastructure businesses, which we've looked at, but it's not something, given the scale they have and our fund size, not something we spend a lot of time on and not where kind of our strengths are. And so we spend time on that application layer, and they tend to look in many ways similar to what traditional equity businesses in the fintech world are. Founders with domain expertise solving kind of a meaningful problem, going after a large market opportunity, and have a thoughtful product and go-to-market motion. They're not always SaaS type business models, but I think broadly, are you targeting an interesting market opportunity where there's a pain point that needs to be solved and applying, in this case, blockchain, crypto to solve that? And the models aren't always defined, but our view is, and to be honest, most of the business we invest in have some revenue traction, even in the crypto world. But in many cases, if that's not defined, if they're solving that and approaching that in a way that's thoughtful, we think the value capture will come. It can be early. I mean, obviously, a classic example of some of that is the late 90s Amazon, right? Like it's a meaningful business pain point, but it's books. There's hundreds of other e-commerce companies that try to solve different aspects of the e-commerce world. Amazon was uniquely able to solve that, expand that into other markets. And the founder was thoughtful enough to understand the feedback from the market and grow that, and also then take that into AWS. And not all the businesses in the blockchain crypto world are going to expand into something like that, but our goal is to back hopefully some of the businesses with founders that are thoughtful, solving a pain point that can then expand into a much larger business and continue to evolve through that.
So you talked about at the beginning there, equity businesses versus token businesses. Can you unpack that a little bit? Are those two distinct categories, or is there overlap between the two? Maybe just start by defining what you mean.
Yeah, sure. So equity businesses, I think most people understand, are traditional businesses with a cap table and having traditional equity like ownerships. You own a percentage of the company and have rights to that company. Token businesses, if you think about Waze and how that was built, the value of that Waze network is in some ways built from everyone else that's contributing as a community. And in doing so, if you were able to reward everyone that was an early contributor to building that network, and that value capture would then be shared with that community, tokens allow you to a way to jumpstart a network without using direct capital as a way to do that. Another example, you could potentially do that with something like Uber. A lot of these businesses required a lot of venture funding to build that out. Token networks in some ways allow for community-driven incentives and a way to kind of incentivize participation, rewarding the people that were there in the earliest moments to help create some incentive alignment and value capture.
And as an investor then, in a token business, you are making a capital investment and you're getting tokens, you're getting equity in some sort of like OpCo and tokens or rights for future tokens. What does the structure typically look
Totally,
like?
yeah. And in most of the cases for us, it's some ownership in the equity business itself, operating business, and some portion in the future token issuance. We typically don't invest in liquid tokens. Once they're liquid, our liquid fund spends a little bit more time looking at that. So in our case, we're getting a SAFT, and so an opportunity to, at a future time when they issue tokens, a percentage ownership of that token network.
You spent, as you said, 3 years at Point72. We'll put that in the category of quote unquote traditional VC or specifically fintech VC where you were focused. And now at Reflexive, you're focused on a different space. Any immediate similarities or differences that you notice about the way that you were thinking about investments, the way that the team was sourcing investments or deploying capital at a firm like Point72 versus what you're doing in the crypto space at Reflexive?
Yeah, I mean, I think actually, a lot of the approach and philosophy that we refined and invested in at Point72 is something we've carried over here, there, and even at my prior role at the Partnership Fund for New York City. It was a very network-driven approach, and so you really focus on sourcing problems and then identifying companies that can uniquely solve that. And in general, what that does is it's an interesting approach, and one that gives you high conviction when you invest, but also when you're sourcing the problem and then you find companies that are solving that, you can bring those companies back to the people, the large organizations on the e-commerce side, on the payment side, the financial institutions, and share some of the most interesting companies that are solving those problems, get those intros into customers and potential customers, which in some ways is more valuable than the capital itself. And if you do that, the feedback loop is pretty amazing, because those institutions will come back and share which of those companies you've introduced have been helpful, have been interesting, and it can give you a unique insight into the ones that know how to engage and scale as well. And it's a win-win situation because you're helping out your network and your broader institutional contacts, but also helping these early startups understand product market fit and go to market. And through that, we get some really unique insight and are able to invest just with a much higher level of conviction. And that's kind of the approach I've applied across the various funds I've been at. The other thing that I learned a lot from at Point72 was valuation discipline. During the COVID timeframe where fintech rounds and just in general funding was just happening at a rapid pace and rounds were getting marked up at valuations and metrics that just looked insane, we stayed pretty disciplined. And I'll give a lot of credit to my colleagues there who together instilled that type of valuation discipline, which in the long term has paid off, though in the short term it looked like, what are we missing? Are we missing something? Because those companies and the valuations are just flying. I think, and the last thing is just, overall, the approach to investing with an open mind and curiosity, whether it's each space we look at, each company we look at. And it's something we did at Point72 as well.
So you mentioned valuations in there. How do you think about valuations in Web3 or in crypto, say the stage at which you're operating?
Luckily, the seed and Series A level, it's not very different from the traditional world from our perspective. We maintain valuation discipline. And so obviously in some cases, the market opportunities can be much bigger, but the risk and the early stage of that also needs to be factored in. So yeah, I think our approach there is to stay disciplined. It's funny because if you ask any investor for great outcomes, they'll never say they overpaid, because there's no such thing, right? If you have a unicorn. But if you continue overpaying on things, it can be challenging, right? Because your overall entry price gets higher and then your returns are there. And people can make references to, for a great outcome, I'm willing to pay any price, but not all investments are great outcomes. And so I think maintaining discipline is a core part to kind of how we approach investing.
You're effectively a price taker. The valuations being, broadly speaking, set by the market. Company at X stage is valued within this band, and then depending on investor appetite, maybe it's toward the top of the band, toward the bottom of the band. And ultimately, your levers are almost invest if the valuation works and you like the company, or don't invest if the valuation just gets too rich. Is that the calculus, or is there more influence that you can have on structuring deal?
I think we, given our fund size, we're not leading deals. At larger funds, like Point72, you're leading deals. And so you can set the price there. In those cases, the company has the choice, if they have multiple term sheets, to choose the price and the investor they want. At our, at this current stage, we're, in some cases we've committed ahead of the lead and we help companies find the lead investor. But the valuation, typically the companies that we're investing in, there's alignment of views on what a reasonable valuation is. And within that range, we're happy to invest. I think obviously that there are some cases where we think the opportunity is interesting, but the valuation is way outside of what we think is normal range. And we unfortunately can't participate or decline to participate. Typically that's established in the first couple of meetings of what their range is, how they're thinking about it. And then, I think most founders are reasonable in understanding that, and they've learned, I think, from the past few years of having a high valuation just makes it more challenging. And I think also founders who are raising a reasonable amount and understand kind of what that capital is going for, and not diluting themselves too much, and making sure they have enough to get to the next milestone where it's de-risked further and they can raise additional capital. I think in the first meeting or two, you can align pretty quickly on how they're thinking about it, how we're thinking about it. So there's never a point where, a month into it, you're like, wait, we're so way off. So that happens pretty early.
Are those valuation considerations the same for an equity business and a token business? If you're the founder of a token business, are you as concerned about not wanting to raise at an over-rich valuation at an early stage? Because ultimately, isn't kind of the goal that the token gets widely distributed, mostly amongst your ecosystem and probably retail users? Like, how much of an impact is there if you overvalue the company early on in a token-based business?
In some ways, you can think about a token business having liquidity is in some ways of an early stage company being public. Obviously not a security, but essentially having that. And so the benefit in some ways from an investor perspective could be that you have some liquidity early and with retail investors and others. And so you can potentially exit. But we try not to think about token businesses in that manner of exit liquidity, and think more about a token business that has good network effects to drive more and more adoption and tokens being used for that. Obviously, there's some benefit to having tokens and liquidity. There's value to that liquidity. And so you can pay a little premium for that liquidity. But in general, we think about the market opportunity and the business and value capture in a similar way at the earlier stages for these businesses.
So maybe we can, to start to wrap up, talk a little bit about specific examples. Maybe to start, I'd be fascinated. You mentioned early on that you view one of the advantages of blockchain as being incentive alignment. And we've talked a little bit about tokens from a project or from a company standpoint. Are there any interesting examples that you've seen of maybe companies that you've invested in, more token-focused businesses that have done a particularly good job at using tokens, using blockchain to align incentives and create value in a way that they wouldn't have been able to in a more traditional fintech or internet business?
I'll give you a few examples. One of the companies we invested in is a company called Modhouse, and broadly in the kind of music entertainment space. If you think about the amount Ticketmaster or Spotify as intermediaries capture between artists and fans, it's a meaningful amount for every transaction and just that coordination. If you think about whether Taylor Swift or all these artists, the earliest fans who were supporters there, who engaged, don't get treated any differently than the fan that just showed up yesterday. They're all paying the same prices, they're engaging in the same way. So there's no benefit and incentive alignment there where people that were early contributed, helped drive that success, getting some of that benefit. And so what Modhouse does is simply have a platform where artists are able to sell collectibles, $3 NFTs. And you can use those NFTs at different points in time to vote on-chain governance. So vote on where the artist performs. You could create these kind of voting mechanisms to engage. To vote, you burn an NFT, and that creates an on-chain vote. And you can imagine in the future, 6 months, a year into it, you can say, who are the fans that engage in some way, shape, or form from day one? And you can give them early access tickets or a way to reward and engage them. And it, in some ways, aligns incentives in a unique way. And you can take that further. One of the things I'm fascinated about is in healthcare in the US, 20% of our GDP is spent on healthcare. The costs that we have in the US around healthcare, we spend so much on addressing problems. But if you could just do preventative care and incentivize people just to work out each day. And there was this interesting platform called STEPN a while back, which you might be familiar with. There are some challenges there, but in general, if we're able to even get everyone to walk for an hour a day and reward them in some ways economically, the government or some insurer is incentivized to give you that than to actually cover the healthcare costs that happen from lack of activity and so on. So what blockchain can do is be the arbiter of that information capture and reward people for specific actions in a way where you can align those incentives. The healthcare system, for instance, has not only an insurance company, a provider, an employer, pharmacies, pharmaceutical companies, and the incentives there are all not very clear. And so a lot of wastage and lack of value creation happens. And so you can create a lot of alignment with an interesting approach to applying blockchain to create that incentive.
So to wrap up then, you mentioned the opportunity that you identified together with some e-commerce platforms around customer acquisition and retention. Any other specific themes that you've explored and that you're particularly focused on at this point?
Yeah, I think one of those I'll mention is, so a lot of regulatory changes can drive the adoption of new technologies. Europe especially is leading the way in some of the regulations coming out. So one around digital product passport, which in the future, it will mandate brands themselves to have some sort of digital product certificate for each product they're selling. Brands are looking at that as an opportunity in some ways, but now that's regulatory pressure for them to add a layer of cost, but also a way for them to engage the end customer. Right now, if you're a brand selling through a retailer, you don't know who's actually bought your product, if they've bought 5 of them and what they have. If now through that digital product passport, you can create a way where they activate and create proof of ownership of that product at the point of purchase, you can then slowly see they have 5 Rolex watches or Nike shoes or LVMH bags and retain those customers and in a way engage them. So customer acquisition, you don't have to go acquire those customers each time. Right now, they don't have any of that visibility. And so we're seeing some interesting companies building around that space of building technology, leveraging blockchain to create ownership of the product at the point of sale. And then that also helps provide more confidence in the resale market and the authentication market. And so that's another example of what we think is an interesting application of blockchain.
Incredible. Sunny, listen, I'm so grateful that you made the time to connect. I have tremendous respect for you. You're such a dynamic guy, creative thinker, and this was a fun conversation. I appreciate it.
Thanks, Will. I enjoyed the conversation as well and look forward to more.
Sunny Parikh, thank you very much for joining us today.
Thanks.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.